Welcome to Breaking News to Trading Moves. Today, we're analyzing the consequences of a pretty big market event, the delisting of Triller. This is the short-form video and creator marketing company that, had staked its claim as a social media contender. Now it's been removed from Nasdaq. So we're going to focus purely on the market reaction, where capital is moving, which companies are gaining, and which ones are feeling the pressure.
And this is, a classic case of the public markets reacting to what is essentially a breach of trust. When a compliance failure like this happens so publicly, it tells investors a story about the company's internal operations that goes way beyond just their consumer product.
So the market is just repricing risk.
It acts very quickly to reprice that risk. That's really the lens we need to use here.
Okay, so let's nail down the primary facts right away.
Right.
What was the actual mechanism that triggered this response?
The mechanism itself was quite procedural, but the consequences are anything but minor. Triller was delisted because they failed to meet the continuous listing requirements. Specifically, they missed multiple deadlines for crucial SEC filings. We're talking about their 2024 annual report and then the 2025 quarterly reports.
For a company that needs investor confidence to grow, that seems like a basic thing to miss.
It's a critical vulnerability. It suggests a lack of internal oversight.
And what does that actually mean for the stock? For the company's ability to, operate in the public markets?
It results in a sudden and really acute loss of credibility and, maybe more practically, a collapse in liquidity. Now, the stock isn't worthless. It can still trade. It moves over the counter or OTC. But just the act of delisting changes its entire risk profile.
And what does that look like for investors holding the stock?
You see two immediate things. First, reduced institutional participation. A lot of major funds, they have rules preventing them from holding OTC stocks. Second, you get potential forced selling.
Forced selling, that's a really key concept here. Can you explain what that looks like on the trading floor for our listeners?
Sure. Imagine an institution like a big pension fund that can only trade on regulated exchanges like Nasdaq. The second a stock like Triller moves to the less regulated OTC market, they are absolutely forced to liquidate their position. It doesn't matter what the price is. They have to sell to follow their own internal rules or what they've promised their clients.
So it's not a choice, it's a mandate.
Exactly. And this rapid mandatory selling just puts immense downward pressure on the price. For Triller, this all translates directly into a higher cost of capital. Borrowing money or raising new equity gets much, much more expensive.
Yeah. So when one ship starts taking on water, the passengers look for the biggest, safest vessels nearby. Let's start there. Who are the clearest market beneficiaries? The large-scale players in the social video and ad space.
This is a direct reinforcement of that winner-take-most idea in the digital world. And it's not really about the exact dollar amount of ad spend Triller might have lost. That figure is, pretty modest compared to the giants. It's more about trust and narrative.
Okay, hold on. I want to push back on that a little. If Triller's ad budget is relatively small, why would a compliance problem there cause a stock like, say, Meta Platforms to move up? Isn't that link a bit thin?
That's a fair question. The answer lies in the psychological impact it has on large advertisers.
Right.
When a smaller, growth-focused platform shows it has poor financial controls, which is what not filing reports implies, it raises all sorts of questions. Questions about data integrity, about user metrics, about overall operational reliability. I mean, if the finance team can't file a 10K, what does that say about the ad performance data they're giving you?
Ah, I see. So the market reaction isn't about a direct transfer of ad budgets dollar for dollar. It's about brands pulling back and consolidating their spending where they have the highest certainty of getting measurable results.
Precisely. Certainty is scale, and scale is those platforms that already dominate the market. When risk pops up in the short-form video sector, budgets naturally flow to the platforms with the deepest inventory, the best measurement tools, and a proven track record. The leaders just become safer harbors in a storm.
And those safe harbors are pretty clear. We're talking about Meta Platforms, Inc., that's META, Alphabet, Inc., which is GOGL, and Snap, Inc., ticker SNAP. Their established compliance and huge user bases just absorb that cautious capital.
That's the primary effect, absolutely. And this consolidation, it extends beyond just the social apps themselves. It moves into the ad tech and the measurement infrastructure, too.
Let's go there next, then. Ad tech. When the smaller platforms are seen as risky, brands shift to those scaled, measurable pipes. This has to be especially true for performance marketing things like app installs or direct-to-consumer campaigns where you need data you can trust.
This is where that idea of financial opacity really hits home. If you're a brand and you're running a massive campaign, maybe spending millions to drive app installs, you need absolute confidence that the platform is reporting performance accurately. A financial compliance failure is just a massive red flag.
So the companies providing the plumbing for transparent, high-volume ad buys become the immediate beneficiaries. They're seen as the secure middlemen.
Exactly. They are insulated from that platform-level risk, but they directly benefit from the budget consolidation. Take a look at the Trade Desk, Inc., ticker TTD. They provide a trusted, scaled platform where brands can reliably buy ad inventory. When a small player like Triller falters, brands just double down on the infrastructure they already know and trust.
And I'm guessing the same logic applies to others in that space.
It does. Think about performance-focused companies like Affluent Corporation, ticker APP, and Magnite, Inc., MGNI. They offer the measured infrastructure and ad exchanges that are seen as rock solid when a competitor's compliance is in question.
So we've covered the beneficiaries of scale and the beneficiaries in the ad tech infrastructure. Let's pivot to a less obvious category of winners. The companies that might benefit from the administrative mess of a delisting itself.
Right, so now we're looking at the infrastructure that handles the newly displaced securities. Once a stock leaves Nasdaq, it doesn't just disappear. It often migrates to trade over the counter. This means the venues and brokerages that facilitate OTC transactions can actually see a modest increase in activity.
So it's the direct question. Where does the volume go now? And who processes that flow?
Brokerage firms with robust systems for handling both listed and unlisted securities, they're positioned to gain from the increased volume and volatility in Triller's new market. Generally, this flows into the established retail brokerage platforms.
So we're thinking about companies like the Charles Schwab Corporation, ticker SCHW, and maybe Interactive Brokers Group, Inc., IBKR. They have the systems to execute trades for investors who are now stuck holding these unlisted securities.
That's right. It's a technical sort of niche benefit, but it's an important part of the full market mechanics. They don't benefit from Triller's failure, per se, but from the administrative shift and the investor activity that follows.
Okay, now let's shift gears completely. Let's talk about the companies facing pressure. The losers. Starting with, well, patient zero, Triller itself.
For Triller Group, Inc., ticker ILLR, the pressure is coming from all sides. We've already talked about the lack of liquidity and the higher cost of capital. But on top of that, institutional research coverage tends to dry up almost completely once a stock is delisted. That lack of visibility makes it incredibly difficult to attract new, stable investment. For a high-growth company that needs cash, that can be a death knell.
And this event casts a shadow on other companies that are valued heavily on their narrative, on their story, right? These story stocks.
Precisely. A story stock's valuation is driven more by the vision of future dominance than by its current profits. When a high-profile story stock fails on something as basic as compliance, the whole investment thesis for that category comes under scrutiny. You see that pressure applied to companies like GD Culture Group Limited, GDC, where investor sentiment is just so important to the stock price.
And that fear of non-compliance seems to be contagious, especially among a specific group of companies. I'm thinking about the ones that came public through reverse mergers or are in that high-risk microcap cohort.
Absolutely. The market has learned to associate certain paths to a public listing, like reverse mergers, with a higher inherent risk profile. This pathway can sometimes let companies bypass some of the intense scrutiny of a traditional IPO.
So Triller's failure acts as a cautionary tale. It encourages investors to sell first and ask questions later across that whole group of thinly traded stocks.
That's the classic reaction. When investors see a compliance breakdown in one company, they assume similar issues might be hiding in other companies with that same high-risk profile. We see that pressure reflected in companies like Mullen Automotive, Inc., ticker MULN, and Faraday Future Intelligent Electric, Inc., FFIE. The market is forcing a higher risk premium on all of them.
Beyond those financial peers, there's one last pressure point: the narrative effect on the broader consumer app and creator economy sector. This can just cool enthusiasm for the whole space.
It really acts like a cold shower on market sentiment. When a high-profile consumer app listing stumbles on something as basic as financial reporting, it just makes investors warier of all the adjacent TikTok alternative or creator economy narratives. The market is always looking for a reason to pull back from high-valuation growth stocks, and a compliance failure is the perfect justification.
Which means companies whose valuation relies on projections of future user growth, even if their own compliance is perfect, might face selling pressure just because the sector sentiment has soured.
Exactly. When the enthusiasm for a sector cools, it creates downward pressure on multiples for everyone in that story. For instance, companies like Match Group, Inc., ticker MTCH, and Pinterest, Inc., PINS, while they are structurally sound, they might feel some pressure from this cooling sentiment around the whole consumer app growth story.
Okay, to summarize this from a trading perspective, a delisting like this reliably creates two dynamics: higher volatility in the microcaps and a flight to safety among the large-scale incumbents.
And as you monitor your own watch list, just remember the general behavior we've observed. The incumbents META, GOGL, SNAP, they tend to be the steadier beneficiaries here. The microcaps, though, including that reverse merger cohort, those will be the names that show the most immediate and exaggerated volatility.
And a final word of caution on that OTC migration. For anyone following Triller's stock now, you have to understand that the move to the OTC market can amplify gaps and slippage. Trading can be much choppier, which requires extra care in how you size your positions.
And here's a final question for you to consider as you wrap all of this up. When a single compliance failure causes the market to demand an immediate higher risk premium from all related growth companies, what hidden measures of internal financial oversight must other firms be maintaining to successfully uphold their current listings?
We must remind you that this discussion is not financial advice or buy or sell recommendations. This is purely the opinion of the author.